Thank you for joining today. Let's dive into contracts. What are contracts in finance? Very simple. These are agreements among parties to do something in the future. Very important, the value of those contracts depend on the value of an underlying asset. So you have a contract on, for example, avocados, bananas. You can have a contract on, for example, delivery of lumber, delivery of gold. So the value of those contracts is what is the underlying asset. There are two types of assets. One is a physical asset, like as I mentioned before, bananas, avocados, gold, silver, commodities. These are all physical products. And if you basically trade those products with a contract, then we are talking about a physical contract. But you can also use those contracts to talk about financial contracts. Financial contracts is if the underlying asset is a non-physical product, such as an option contract, contracts on interest rates, stock indexes, currencies, credit default swaps, and so on, then we call this financial contract. Otherwise, we call it physical contract. So as you said, as I mentioned, contract, piece of paper, document between two parties, two traders to do something in the future. There are, I would say, 4 or 5 major types of contracts. The first one are forward contracts. This is an agreement to trade an underlying asset. Again, could be a physical product, physical asset, or non-physical asset in the future at a price agreed today. So you are saying, okay, I buy avocados, but I don't buy avocados today for $2. We use the contract and say, okay, in the future, I will pay $2 for avocados. Means today money does not exchange hands. We just agree via a forward contract, and then in 10 days, 20 days, 30 days, 6 months, 1 year, 10 years, we basically exchange the product, avocados, bananas, with money. So it's a forward contract because things happen in the forward market in the future. So agreement to trade underlying as in the future at a price agreed upon today. Future contracts is exactly the same mechanism, but the only difference is it's a standardized contract, standardized forward contract, and there is a middleman, which is a clearinghouse. So rather than having two parties to discuss, okay, what is the price for avocados? When are we going to exchange money with the product? There's a clearinghouse that basically collects the money and ensures no party becomes default. There are a few mechanisms which I will explain in another video, but key here is it's a standardized forward contract, and there are more mechanisms to ensure there is no counterparty risk. Option contracts, a bit different. Also, you agree on something in the future via a contract, but the difference here, that's why it's called option contract, the price agreed is not fixed. It allows the holder to buy or sell an underlying instrument at a specified price at or before a specified date in the future. Means you have a right. For example, in 30 days you have a right, but not the obligation, if you're the holder of such a contract, to buy avocados for $2. But you don't need to exchange. If you have a forward in the future contract, then in 30 days, if you have agreed to buy avocados for $2, then you exchange and you trade. For an option contract, if you're the option holder, and again, there are like different options positions, whether you're in a sell or in a buy position. But if we simplify, if you're the option holder, it gives you the right. So you can buy avocados at $2, But if at this time the price of avocados is $1, then you don't need to exercise. Yeah. Whereas with forward and future contracts, you have to exercise. And then depending on the price and your position, you make or lose money. Swap contracts, a different form, is a bit different. It's an agreement to exchange payments of periodic cash flow that depend on future assets, price, or interest rates. There are interest rate swaps, commodity swaps, currency swaps, equity swaps. I will make another video to go into the details. And then lastly, we talk about other contracts. It's mainly around insurance contracts, and then you have a contract with an insurance company. If something happens in the future, then you basically get compensated for any loss and so on. Yeah, so these are the, I would say, four or five key areas when talking about contracts in finance. Thank you so much for listening. Talk to you later.